Hello everyone, welcome to the weekly lecture videos. In this video, I'm going to talk about another very commonly used investment decision technique, which is the internal rate of return. So internal rate of return is the most important alternative to NPV. And this is universally known as IRR. Okay, so we will see shortly that IRR is closely related to NPV. With the IRR, we try to find a single rate of return that summarizes the merits of a project. Furthermore, we want this rate to be an internal rate in the sense that it depends only on the cash flows of a particular investment, not on rates offered elsewhere. Okay, so let's take a very simple example. Consider a project that costs $100 today and pays $110 in 1 year. Suppose you were asked, what is the rate of return on this investment? What would you say? It seems both natural and obvious to say that the return is 10% because for every dollar we put in, we get $1.1 back. In fact, this 10% is the IRR, okay, internal rate of return on this investment. Now, is this project with its 10% IRR a good investment? Once again, it would seem apparent that this is a good investment only if our required rate of return is less than 10%. Okay, so which means that the decision rule of IRR is that the IRR needs to be compared with the required rate of return. So if IRR of a project exceeds the required rate of return, that means if IRR of a project is higher than the required rate of return of the project, then the project will be accepted. Whereas if IRR is less than the required rate of return, then it should be rejected. Okay, so for example, if IRR of a project is 10% and the required rate of return is 12%, then the project should be rejected. Okay, on the other hand, if IRR is 10% and the required rate of return of a project is 8%, the project should be accepted because the difference will be a value addition. Okay, so IRR is an widely used method in practice, and also you see that it's intuitively easy to understand because we see a rate of return of a project and we compare this with our required return from the project, and we compare them and we decide that whether the project generates a return sufficient to cover up our required return, and on the basis of that we take and accept our reject decision. Now look at this. We expect that the cash flows over the 5-year life of a project will be $2,000 in the first 2 years, $4,000 in the next 2, and $5,000 in the last year. It's cost about $10,000. Now estimate the IRR of the project. Okay. Now look, if we want to do it using calculator, there is no straightforward way to measure the IRR of a project. We need to do a trial and error method. Okay. However, we can use Excel spreadsheet to directly calculate the IRR. Okay. So one concept we need to understand before we go to know what is the trial and error method, we need to know one important concept, which is the IRR is a rate that makes NPV 0. Okay. Now look how we can explain this. In fact, IRR is simply a rate, right? And that rate, as I said, that rate makes the NPV equal to 0 because it tells us at which rate the present value of cash inflows will be equal to the present value of cash outflows. Okay, so you can see from this diagram, you see that in the horizontal axis, we have the discounted 5%, 10%, 15%, 20%, 25%, 13% or so, and here we have NPV. Okay. Now you see from our understanding of NPV, you see that as the required rate of return increases, NPV decreases. Okay. And as the required rate of return decreases, NPV increases. Okay. Now there is a rate, okay, you can see it here, which is IRR is 13.1%. So this is the rate at which NPV is equal to 0. Okay, NPV is equal to 0. And ideally, why NPV is equal to 0? Because the present value of inflows is equal to present value of outflows. And you can see that when our required rate of return is less than IRR, okay, less than this 13.1%, our NPV is positive. Okay, why NPV is positive? Because if IRR makes NPV 0, if our discount rate is less than IRR, then our present value of inflows will be higher than our investment. That's why NPV is positive. Whereas if our discount rate is higher than the IRR, then NPV will be negative. Okay, because present value of inflows will be less than the outflows. Now, as I was talking about that, how do we get this? How do we get the IRR? Using a calculator, we need to do a trial and error method. So first of all, we need to find out, we need to use an arbitrary discount rate. Okay, arbitrary discount rate, and we calculate NPV. So if we see that the NPV is positive, which means that the rate we have used is a low rate. Okay, so we have to use a higher rate so that our NPV becomes negative. Okay, so once we have a lower rate and positive NPV, and we have a higher rate and negative NPV, then we can use them to find out the IRR. Okay, so in an exam environment, I will not want you to calculate IRR using this trial and error method, but in our weekly session, I will show you how you can use use Excel spreadsheet to calculate IRR. Okay. Now look at this point, the NPV versus IRR. Now, you need to understand two things. In the case of NPV, what do? We accept a project if NPV is positive, and we reject a project when NPV is negative. And in the case of IRR, and don't forget IRR makes NPV 0, we said that if IRR is greater than the required rate of return, then we accept the project. So theoretically, or in most instances, NPV and IRR will lead to the same decision. That means if NPV is positive, right, we accept it. And IRR, if NPV is positive of a project, then IRR should be greater than the required rate of return. Okay, why? Look, that this required rate of return was used to calculate NPV. Okay, and if that is positive, means that the present value of inflows are higher than the outflows, then the IRR that makes NPV 0, that must be higher than the required rate of return. Okay, so that's why NPV and IRR generally lead to the same decision. However, some complexity arises when there are non-conventional cash flows and when there are mutually exclusive projects. So when there are non-conventional cash flows and mutually exclusive projects, then NPV and IRR may lead different decisions. Okay, so let's briefly discuss these 2 points. Okay, so first of all, non-conventional cash flows. Okay, so far the examples of project cash flows that we have seen, in all of these examples, there were conventional cash flow. So what is the conventional cash flow? Conventional cash flow was initial investment, which is a negative cash flow at the inception of the project, then followed by a stream of positive cash flows. Okay, so once again, initial investment, which is a negative cash flow at the inception, and then in a stream of positive cash flows. Okay, positive cash flows over the life of the project. However, when there is a non-conventional cash flow, so non-conventional cash flow means you have a negative cash flow at the inception of the project, and you also have negative cash flow during the life of the project. Okay, so it will not be simply just a stream of positive cash flows, but you also may have a negative cash flow during the life of the project. How it is possible? For example, in any particular year, if you need to spend a lot of money for maintenance or overhauling a project, then you may have a negative cash flow during the life of the project. And this is the non-conventional cash flow. And if there is non-conventional cash flow, the problem we find is we may have more than one IRR. Okay, so look at this example. Suppose we have a strip mining project that requires a $60 investment, and our cash flow in the first year will be $155. In the second year, the mine is depleted, but we have to spend $100 to restore the terrain. Okay, so you can see that although the first year cash flow is positive, but the second year cash flow is negative. As this is the case, in this case, IRR will be misleading, because when we have these non-conventional cash flows, then we may have more than one IRR. Okay, so you can see that in this case, NPV becomes 0 when a discount rate is 25%. Okay, so at 25% rate, NPV becomes 0, which means that our IRR is 25%. However, NPV also is close to 0 when our discount rate is 33%, which means that this is another IRR. Okay, now which of this correct? Okay, you can see this. So this is an NPV profile again, and the NPV at a different discount rate. So when IRR is 25%, I mean, when a discount rate is 25%, NPV is 0. And when the discount rate is 33.3%, NPV is again 0. So we have more than one IRR. Now, which one is the right IRR, and which one we compare with the required rate of return to take and accept and reject decision? We don't know. That is undecided. That's why when there is a non-conventional cash flow, we cannot reliably take and accept or reject decision using IRR. Okay. So the moral of the story is that when cash flows are non-conventional, a strange thing can start to happen to the IRR. This is not anything to get upset about, however, because the NPV rule always works just fine. So for this type of project, we go with NPV. Okay. Then let's come to mutually exclusive projects. Mutually exclusive projects are such, I mean, say two projects are mutually exclusive when they are such that acceptance of one project will reject the other. Okay, then they will be called mutually exclusive. Now, even if there is a single IRR, another problem can arise concerning mutually exclusive decisions. Okay, so as I was saying that if you have two projects X and Y, they are mutually exclusive. Taking one means you are rejecting other. So thus far, we have asked whether or not a given investment is worth undertaking, right? Whether we should accept a project or not. Now, there is a related question, however, that comes up very often. Given two or more mutually exclusive investment, which one is the best, right? Try to understand. If you have multiple projects and if they are independent projects, you calculate IRR and you accept the one with the highest IRR or one with the highest NPV, right? However, if there are two or more mutually exclusive projects, mutually exclusive means you need to accept one and you have to reject the other. Now, the question is which one is best, right? The best one should have the largest NPV, okay? Largest NPV. Now, can we say that the best one also has the highest return? The answer is no, okay? So there is no doubt that the best one among multiple projects and mutually exclusive, the best one is the one with the largest NPV, but best one may not necessarily have the highest rate of return, okay? So look at this example. IRR of project A, you have two projects, project A and project B. IRR of project A is 24% and IRR of project B is 21%. Okay. Now NPV and IRR rankings conflict for some discount rates. Okay. So look at this. When your discount rate is 0, okay, and these are the cash flows. So NPV of project B is higher, you can say here. However, if you come here, you see. So in this case, when our discount rate is, for example, 5%, then you should take project B because it has higher NPV. However, when our discount rate is 15%, you should take project A because here NPV is higher than project B. Okay. The conflict between the IRR and NPV for mutually exclusive investment can also be expressed using these NPV profiles. Okay, in this figure, notice that NPV profile crosses at about 11% here. Okay, it crosses at about 11%. Notice also that at any discount rate less than 11.1%, the NPV of, so you notice that the NPV profiles crosses at about 11%, and for any discount rate less than this 11.1%, NPV of project B is higher. Okay, it means that taking B benefits us more than taking A. However, you see that A's IRR is higher, right? A's IRR is higher than B. Okay, so at any rate greater than 11.1%, investment A has a greater NPV. You can see it here. So this example illustrates that whenever we have mutually exclusive projects, we should not rank them on the basis of their IRRs. More generally, anytime we are comparing investments to determine which is best, IRRs can be misleading. Instead, we need to look at the relative NPVs to avoid the possibility of choosing incorrect. Okay, so remember, we are ultimately interested in creating value for the shareholders. So the option with the highest NPV is preferred regardless of the relative returns. Okay, so if it seems counterintuitive to you, think of it this way. Suppose you have two investments. One has a 10% return and makes $100 richer immediately. Another has a 20% return and makes you 50% richer immediately. Which one do you think better? You would rather have $100 than $50 regardless of the return, right? So we like the first one better. So so you might have a question in your mind that why this NPV and IRR produces conflicting results, particularly in case of the mutually exclusive projects. So this conflicting ranking may arise for size differences or timing differences. Okay, sometimes projects may have size differences, or projects may be different in size. For example, one project may be a very big project, whereas one at a small project. Now, in the case of a small project, since the small projects will require a smaller initial investment, so the initial investment will be recovered quickly. Okay. On the other hand, for large projects, it might take a long time to recover the initial investment. Okay. And if the opportunity cost is higher, then for the valuable projects, high discount rate will favor small projects. Okay, timing difference can also create this conflict because you know that for some projects may have a 3-year life. Other projects may have longer life, for example, 5 or 7 years. Now cash flows are coming over this different life and in different times. These also can result in this conflict ranking. Now, as I mentioned previously, that when there is a conflict in ranking between NPV and IRR, we should straight away use the suggestion by NPV. Okay, because NPV is theoretically superior. NPV gives us a direct measure of how much value addition. And also another point is reinvestment rate assumption. NPV's reinvestment rate assumption is more realistic because NPV assumes that any interim cash flows will be reinvested at the cost of capital or the required rate of return. For example, you know, a 5-year project generates cash inflows in year 1, year 2, year 3. Now these cash flows will be reinvested. Right? And since we are using the required rate of return to discount the cash flows, the implied assumption is that those interim cash flows are reinvested at the required rate of return. So which is a more reasonable assumption. In the case of IRR, on the other hand, we are assuming that these interim cash flows are reinvested at the IRR. Now, this IRR is relevant for this project. So when we reinvest these interim cash flows, we should be reinvesting them at a required rate of return of the firm, not the IRR of this project. Right, so reinvestment rate assumption of IRR is also not theoretically correct. Okay, so due to this problem with the reinvestment rate assumption, due to the unreliable result of IRR in the case of non-conventional cash flows and mutually exclusive projects, NPV is superior, and in the case of conflict between NPV and IRR, we should go with the NPV's decision. So these are the advantages and disadvantages of IRR. So IRR is more intuitive and easy to understand because that's a rate of return. See, you know, when we analyze an investment, people in general, for example, financial analysts in particular, they seem to prefer talking about a rate of return, right, rather than the dollar amount. That's why it is easy to understand. Right, like you understand. So if you are going to invest and you say that it will generate a return of 10%, it's easy to understand. Right, and it is also closely related to NPV, just for some exceptional cases like non-conventional cash flows or mutually exclusive projects. It is unreliable, but in other cases, it is very close to NPV. Okay, so we already know the disadvantages of IRR in the case of non-conventional and mutually exclusive projects. Okay, so this is the end of this video. So essentially in this video, we learned about IRR compared between NPV and IRR. And we finally discussed that in the case of conflicting ranking, which decision we should be going with. Okay, so thank you very much.